Between February 2024 and January 2025, Jeff Bezos liquidated $8.5 billion worth of Amazon shares. Mark Zuckerberg offloaded $4.3 billion in Meta stock, both transactions occurring at peak valuations, same time frame. Bezos publicly stated, "My confidence in Amazon has never been higher." Zuckerberg declared on investor calls, "We're more optimistic than ever, committed for the long haul." Notice the disconnect between statements and actions. You might assume this represents portfolio diversification, inheritance planning, or tax optimization. Incorrect. This follows a blueprint that's emerged before every significant market downturn over the past quarter century. Dot-com collapse, 2008 housing crisis, COVID market plunge, identical billionaire strategy, identical mechanics, different justification every instance. And presently, this blueprint is reaching its terminal phase. Financial markets aren't arbitrary. They aren't unpredictable chaos. They operate on blueprints. And there's one blueprint that emerges before every major equity market collapse in contemporary history. A three-phase insider liquidation blueprint. Once you recognize it, it becomes impossible to ignore. And once you comprehend it, the entire market rhythm becomes foreseeable. Phase 1. Routine liquidation. Annually, corporate insiders liquidate stock, 10 to 15% of their positions. This represents baseline ordinary. Executives redistribute their capital, they acquire property, they capitalize other ventures, they handle tax liabilities. This occurs annually. It's recorded in SEC disclosures. It's anticipated. It's not an alarm signal. It's simply standard wealth management. Phase 2, intensification. Insider liquidation volume surges to 2 to 3 times baseline thresholds. The market's been ascending for years. Multiples are becoming extended. Price-to-earnings ratios are amplified. But superficially, everything still appears robust. Corporations exceed profit projections. Wall Street analysts elevate their target prices. Financial journalists celebrate fresh record peaks. The economy appears vigorous. And discreetly, without substantial coverage, insiders begin liquidating larger stakes. Not sufficient to activate compliance warnings, not sufficient to generate media attention, but the volume is unmistakable. Twice the baseline rate, occasionally triple. The intensification is quantifiable. It's in the metrics. Phase 3, maximum withdrawal. This is the indicator. Insider liquidation reaches more than 3 times baseline thresholds. Sometimes quadruple, sometimes quintuple. And fundamentally, it's not merely middle-tier vice presidents liquidating equity compensation for a deposit on vacation property. It's the originators, it's the chief executives, it's the board directors who've been present since inception. The individuals who constructed these enterprises, the individuals who understand every granular detail of operations, consumer patterns, competitive pressures, profit margin constraints. They're liquidating at record peaks, billions in capital, converting to cash. And here's what the metrics reveal. 6 to 18 months following Phase 3 insider liquidation peaks, the market collapses. Not occasionally, not sporadically. Every single instance this blueprint has manifested over the past 25 years, a substantial market correction has materialized. Why does this blueprint function? Because insiders function with informational advantage. They examine quarterly profit metrics, 2 weeks preceding public disclosure. They analyze client acquisition expenses escalating before Wall Street notices. They observe client attrition accelerating in weekly analytics. They participate in leadership meetings where the chief financial officer presents profit margin deterioration projections. They attend board sessions where risk executives conduct confidential vulnerability assessments on the financial position. They recognize revenue expansion is decelerating even as the equity price continues ascending because promotional expenditure is escalating to preserve the illusion of expansion. They perceive the divergence between the stock's multiple and the corporation's genuine operational condition. And when that divergence becomes sufficiently substantial, when the market valuation implies projections the enterprise cannot conceivably fulfill, when the risk-return calculation becomes asymmetrical, they liquidate. Not because they distrust the corporation, not because they're cynical about the extended term trajectory, but because the calculations don't support it. Appreciation from present thresholds, perhaps 10, 15%. Depreciation, if conditions align with valuation, 30, 40, 50%. They don't require forecasting the trajectory. They simply require perceiving present conditions accurately, and they accomplish this. This is not hypothesis. This is not conjecture. This is quantitative blueprint identification. The metrics are entirely accessible. Every insider transaction exceeding $10,000 must be disclosed to the SEC on Form 4 within 2 trading days of completion. The volume is documented, the chronology is documented, the identities are documented. It's all public documentation. You simply require understanding what you're examining. And presently, as of January 2025, insider liquidation is operating at 4.2 times baseline thresholds. That's elevated beyond the maximum before the COVID collapse in 2020, elevated beyond the thresholds before the 2008 housing crisis. We are in phase 3. The blueprint is not commencing. It's not intensifying. It is executing presently. If this blueprint resonates with you, hit subscribe, because throughout the remainder of this presentation and the presentations that follow, we're going to monitor precisely how phase 3 completes in live time. We're going to present you the specific identities, the specific transactions, and what the historical blueprint indicates materializes subsequently. 1999 through early 2000, the internet explosion, the Nasdaq Composite Index ascending relentlessly. Everyone's discussing the transformed economy. The internet revolutionizes everything. Conventional valuation frameworks don't function anymore. Pets.com conducts its initial offering. 30-year-old originators become billionaires instantaneously on corporations with zero profitability. March 10th, 2000, Nasdaq maximizes at 5,048, the absolute summit. And in the 18 months preceding that summit, from late 1999 through early 2000, technology corporation insiders liquidated $40 billion in stock, not 4 million, 40 billion with a B. Jeff Bezos liquidated $1.8 billion in Amazon equity during 1999 and 2000. Amazon was exchanging at 300 times profit. He liquidated. Mark Cuban liquidated Broadcast.com to Yahoo for $5.7 billion entirely stock, then immediately commenced liquidating the Yahoo equity, withdrew with billions in capital before Yahoo deteriorated. Insider liquidation volume throughout the technology sector reached 4.1 times baseline thresholds in Q4 1999 and Q1 2000, the maximum on documentation at that instance. The justification, diversification, securing some gains, capitalizing fresh initiatives, nothing concerning. These originators still maintain confidence in their corporation's extended term. Meanwhile, individual investors are purchasing. CNBC broadcast segments titled Dow 36,000. Wall Street analysts proclaim anyone not invested in technology stocks is overlooking the opportunity of existence. The transformed economy doesn't comply with previous principles. This instance is unique. March 10th, 2000, the summit, and then the collapse commences. By October 2002, the Nasdaq has declined 78% from the maximum. $5 trillion in market capitalization evaporated, eliminated. Pets.com ceased operations. Webvan insolvent, eToys zero. Numerous corporations that conducted initial offerings at billion-dollar multiples exchanging for fractions or delisted completely. Technology stocks that had exchanged at 200 times profit became 2-cent speculative stocks. Individual investors purchased the decline throughout from 5,000 to 4,000, purchased additional from 4,000 to 3,000, continued purchasing. This is a purchasing opportunity, correct? The fundamentals haven't transformed. It's merely a correction. But the insiders who liquidated at the summit, they preserved their capital. They converted billions to cash at 5,000 on the Nasdaq. They didn't purchase the decline. They observed the collapse from the security of liquidity. The population retained worthless equity certificates. The insiders had already withdrawn. Phase 3 executed flawlessly. Identical blueprint. Insiders liquidating at summit. Public purchasing throughout the decline. And by the instance it became apparent the market was in genuine distress, the repositioning was already finalized. 2006 through 2007, the property explosion. Real estate valuations ascending year following year. Subprime mortgages assembled into AAA-rated instruments. Financial institutions leveraging 30 to 1 on mortgage-backed instruments. Everyone's accumulating wealth. The S&P 500 reaches fresh maximums month following month. October 9th, 2007, S&P 500 maximizes at 1565, the summit. And in the 2 years preceding that summit, 2006 through 2007, financial institution leadership liquidated $10 billion in stock. The chief executives of the precise institutions that would deteriorate or necessitate government intervention 18 months subsequently. Dick Fuld, chief executive of Lehman Brothers, liquidated $500 million in Lehman stock between 2000 and 2008. Majority of it concentrated in 2006 and 2007 precisely at the summit, while publicly informing investors and personnel that Lehman's financial position was exceptionally solid. Angelo Mozilo, chief executive of Countrywide Financial, the largest subprime mortgage provider in America, liquidated over $400 million in stock during 2006 and 2007, while Countrywide was originating the most hazardous subprime advances in the market, advances that would subsequently default at rates exceeding 50%. Mozilo was liquidating his personal stake. Chuck Prince, chief executive of Citigroup, liquidated a substantial portion of his Citigroup positions in 2007, months before resigning in November 2007 as the subprime crisis commenced to materialize. Citigroup would proceed to necessitate a government intervention of $45 billion. Insider liquidation at substantial financial institutions reached 3.8 times baseline thresholds during 2006 and 2007. The justification: inheritance planning, diversification, pre-scheduled 10b5 to 1 transaction programs. Nothing irregular, merely prudent wealth management. These leadership maintain complete confidence in their institutions. And here's what majority don't understand. The SEC actually investigated portions of this liquidation, discovered blueprints that appeared suspicious, leadership liquidating precisely before substantial losses were disclosed, chronology that appeared excessively precise to be coincidental, but nothing materialized. No accusations, no sanctions, because technically the transaction programs were pre-scheduled. Plausible deniability. They always possess a justification. Inheritance planning, diversification, but the volume communicates everything. October 2007, the summit, then the collapse. March 2009, S&P 500 reaches bottom at 676, declined 57%. Lehman Brothers insolvency, Bear Stearns deterioration, Merrill Lynch emergency transaction to Bank of America, AIG government acquisition, $8 trillion in household capital destroyed. And the identical leadership who appeared on CNBC in 2006 and 2007 proclaiming property fundamentals are robust and our risk management is best in class, they were liquidating their own stock. They possessed access to internal risk evaluations. They understood the subprime vulnerability. They understood the instruments were mispriced. They understood the leverage calculations were unsustainable. They liquidated. Phase 3, executed flawlessly. Again, different sector, identical mechanics. The blueprint doesn't concern itself with justifications. It simply executes. January through February 2020, the S&P 500 establishing fresh all-time maximums week following week. Unemployment at 50-year minimums, corporate profit exceeding projections, the extended bull market in American history, everything is satisfactory. And during those precise 2 months, corporate insiders liquidated $90 billion in stock, the maximum 2-month liquidation aggregate ever documented at that instance. Jeff Bezos, February 2020, liquidated $4.1 billion in Amazon stock precisely at the summit. Amazon exchanging near all-time maximums, $4 billion converted to cash. Throughout the technology sector, chief executives accelerated liquidation in January and February. Not routine diversification. Accelerated programs, larger blocks, insider liquidation reached 5.2 times baseline thresholds, the maximum multiple on documentation. February 19th, 2020, S&P 500 maximizes at 3,386, the absolute summit. 3 weeks subsequently, March 23rd, 2020, S&P collapses to 2,237, declined 34% in 33 days, the most rapid collapse in history. Did they understand COVID was materializing? No. They didn't possess classified intelligence about a pathogen, but they possessed access to supply chain metrics, live analytics from operations teams in China, presenting manufacturing facility shutdowns expanding in January, orders postponed, logistics disrupted, risk management teams executing scenarios on extended Chinese manufacturing shutdowns. They didn't require understanding the pathogen. They required perceiving the vulnerability. And the vulnerability was asymmetrical. Appreciation from present thresholds, perhaps 5 to 10%. Depreciation if something disrupts the global economy, 30, 40, 50%. The calculations indicated liquidate. They liquidated. Identical blueprint, third instance, different crisis, identical mechanics. And it's materializing again, presently. 2024 through January 2025, the S&P 500 above 6,000, all-time maximums, the AI explosion. NVIDIA appreciated more than 10 times in 2 years, magnificent 7 technology stocks propelling the market. Wall Street analysts discussing soft landing, optimal economy, inflation declined, expansion positive. Everything is satisfactory again. And insider liquidation is presently operating at 4.2 times baseline thresholds, elevated beyond the maximum before COVID, elevated beyond 2007 before the housing crisis, approaching 2000 internet levels. Jeff Bezos, November 2023, announces he's relocating from Washington state to Florida. Public rationale: be proximate to family near Blue Origin operations. Then February 2024 through January 2025, Bezos liquidated $8.5 billion in Amazon stock, liquidated at 175 to 180 per share, all-time maximums for Amazon. Why does Florida matter? Washington imposes 7% capital gains assessment. Florida imposes 0 on $8.5 billion in stock liquidations. Relocating to Florida preserved Bezos approximately $800 million in state assessments. He proclaimed the relocation was for Blue Origin, but Blue Origin loses capital. It's capitalized by Bezos liquidating Amazon stock. He didn't require relocating for Blue Origin. He relocated to avoid $800 million in assessments on the largest stock liquidation of his existence. Mark Zuckerberg throughout 2024 liquidated $4.3 billion in Meta stock. Meta exchanging between $400 and $500 per share. All-time maximum multiples. The public explanation, charitable contribution, capitalizing the Chan Zuckerberg initiative. But Chan Zuckerberg initiative already possesses tens of billions. It doesn't necessitate another 4.3 billion presently. Zuck is liquidating at multiples Meta has never experienced previously. And he's liquidating in substantial magnitude. Jensen Huang, chief executive of NVIDIA, throughout 2024, liquidated $1.2 billion in NVIDIA stock. NVIDIA exchanging predominantly in the $800 to $900 spectrum near all-time maximums. The explanation: pre-scheduled 10b5-1 transaction program, automatic liquidations. But who schedules the program? Jensen. When did he schedule it? At all-time maximums. The program executes automatically? Yes. But the determination to establish the program, the chronology, the magnitude, his determination established at the summit. This blueprint extends throughout sectors. Financial institution chief executives liquidating, retail chief executives liquidating, healthcare leadership liquidating, throughout every substantial sector. Insider liquidation operating at 3 to 4 times baseline rates. The justifications are always identical: inheritance planning, diversification, charitable contribution, assessment optimization, pre-scheduled programs, all technically accurate, all plausible, but the volume communicates the genuine narrative. Bezos didn't necessitate $8.5 billion for Blue Origin. Blue Origin's annual allocation is perhaps $1 billion. He liquidated 8 times that. Zuck doesn't necessitate $4 billion for charity presently. These are pre-scheduled programs. Yes, but they scheduled those programs at all-time maximums. They determined when, they determined how substantial. We're in phase 3 presently. Insider liquidation at 4.2 times baseline thresholds. Elevated beyond before COVID, elevated beyond before 2008. The blueprint is executing. What activates the collapse? We don't understand. Perhaps recession, perhaps obligation crisis, perhaps geopolitical disruption, perhaps AI explosion collapsing when revenue doesn't justify multiples. Unknown. but the blueprint indicates 6 to 18 months following maximum insider liquidation. Collapse materializes. Maximum liquidation materialized Q3, Q4 2024. That positions the collapse timeframe at Q1 2025 through Q3 2026. We are in that timeframe presently. And here's what they don't communicate to you. By the instance CNBC reports billionaires liquidating stocks, it's completed. The liquidation materialized 3 to 6 months earlier in SEC disclosures nobody examines. You're receiving this information presently because I'm presenting you the genuine disclosures from Q3 and Q4 2024. The mainstream journalists will report this in months, following the liquidation is finalized, following intelligent capital has repositioned, conceivably following the collapse has already commenced. The intelligent capital has already converted. The question is, will you? This is not forecast. This is blueprint identification. Identical blueprint in 2000. Explosion. Technology multiples disconnected from conditions. Insiders liquidated 40 billion. Collapse materialized. NASDAQ declined 78%. 5 trillion in market capitalization evaporated. Identical blueprint in 2007. Property explosion. Financial institutions leveraged 30 to 1 on mortgage instruments. Financial institution chief executives liquidated 10 billion. Collapse materialized. S&P declined 57%. 8 trillion in household capital destroyed. Identical blueprint in 2020. Markets at summits before COVID. Insiders liquidated 90 billion in January, February. Collapse materialized, declined 34% in 33 days. And presently 2024, 2025, AI explosion, markets at all-time maximums, insiders liquidating over 100 billion, phase 3 executing. Identical blueprint, identical mechanics, identical outcome ahead. The blueprint has never failed to complete itself, not once in 25 years. When insiders who constructed these enterprises liquidate at summits in volumes 3, 4, 5 times baseline thresholds, they understand something. They understand the risk return is broken. Why does this blueprint function? Because insiders function with informational advantage. They examine quarterly profit 2 weeks before public disclosure. They analyze genuine metrics in board sessions. They observe client acquisition expenses escalating, attrition rates increasing, profit margins compressing, revenue expansion decelerating, even as equity valuation accelerates. They perceive the divergence between what the equity valuation implies about future expansion and what the enterprise can realistically produce. When that divergence becomes sufficiently substantial, they liquidate. When you're valued 50, 80, 100 billion and your stock is at multiples never achieved previously, and internal analytics present expansion decelerating, what do you execute? You operate the calculations. Appreciation from here, perhaps 10, 15, 20% if momentum persists. Depreciation if conditions align, 30, 40, 50, 60%. The calculations indicate liquidate presently, preserve capital, repurchase following correction if you desire, but presently at these multiples, vulnerability is asymmetrical and they don't necessitate understanding what activates the collapse. Bezos didn't understand COVID was materializing in February 2020, but he understood vulnerability was elevated. Financial institution chief executives didn't understand Lehman would fail, but they understood subprime vulnerability was catastrophic. Today's insiders don't understand what activates the subsequent collapse, but they perceive multiples disconnected from fundamentals. AI enthusiasm exceeding realistic revenue. Consumer obligation at records. Corporate obligation at records, government obligation at 40 trillion. They perceive the vulnerabilities, so they liquidate. The blueprint does not necessitate your comprehension. It simply executes. A mechanics, quantitative, foreseeable. So what do you execute with this information? Option 1, disregard it. Maintain this instance is unique. Maintain Bezos liquidated 8.5 billion for Blue Origin. Maintain Zuck necessitated 4 billion for charity presently, retain at all-time maximums, and anticipate the blueprint discontinues for the first instance ever. Your determination. Option 2, position accordingly. Comprehend we're in phase 3. Collapse time frame is 6 to 18 months from maximum insider liquidation. Maximum was Q3, Q4 2024. Time frame is Q1 2025 through Q3 2026. We're in it. You don't necessitate liquidating everything, but comprehend vulnerability is asymmetrical. Appreciation perhaps 10 to 15%. Depreciation 30 to 50%. Position accordingly. Secure some gains, reduce stake magnitudes, increase cash, transition to defensive sectors, acquire protection. Tactics depend on your circumstances, but the principle is straightforward. Follow the intelligent capital. When billionaires liquidate their own corporations at all-time maximums and volumes 4 times baseline, they understand something. They perceive vulnerability you don't perceive. This is not financial guidance. This is blueprint identification. The determination is yours. But comprehend the blueprint is executing presently. Maximum liquidation, Q3, Q4, 2024. Collapse timeframe Q1 2025 through Q3 2026. We are inside that timeframe. If you desire to observe how this blueprint completes, if you desire to monitor insider liquidation metrics in live analytics, if you desire to comprehend what materializes when phase 3 transitions to collapse, subscribe presently. We're going to follow every SEC disclosure, every insider liquidation, every indicator as this unfolds. Hit like if this blueprint resonates with you. Comment below. Are you positioned for the blueprint or retaining at all-time maximums? Because the blueprint is executing presently. And unlike every instance previously, this instance you possess the opportunity to perceive it while it's materializing, rather than comprehending it only following the collapse is finalized.